All right, so yesterday we had kind of started to lay out the foundation for the comps, and what I had done was, so we laid out the yearlies, 2011, 2012. We talked about pulling out, cleaning net income, pulling out non-recurring items, and then I told you that, I'm just going to lay out the quarterlies, the 3 quarters from 2011 and 2012. I do want to walk through a couple things, and I do recommend you giving it a try. Just for extra practice. But when you pull up a quarterly statement for Costco, this is what you'll get. So for example, I just pulled in the latest 3 quarters because each of those 3 quarters gives you the year before. You know what I'm saying? I didn't pull in 6 quarterly reports. I just pulled in the 2012s, Q1, Q2, Q3, and obviously in the report it gave me 2012 and 2011. But there is a couple of things I want to make sure that you're aware of. A couple little tricky things. Number one, that's a little bit different than when we laid out the annual reports. So I'm going to pull out the latest quarterly report. I believe that's the latest. So if you pull up the quarterly report and you go down to, it jumps right into the statement of income. You have revenue as normal. You have operating expenses, merchandise costs, selling, general administrative, pre-opening expenses. You would have had to have pulled out, pulling the taxes down. There's also this provision for impaired assets. This is definitely non-recurring. This is an asset impairment. So putting together the quarterlies is good practice in doing everything we did yesterday. So what I do recommend is over the weekend, if you need more practice in comps and stuff, to try to do this on your own and make sure you match the numbers. Okay. Other income, here's interest expense. Here's interest income and other. Again, we had to, if you see interest income and other, you want to break out the interest income from the other income, because for us, for bankers, we have interest as a separate section. They seem to blend in interest and other income all as one big section. We want to separate, so interest from other. So interest income and other, when I do a word search on that, maybe this punctuation is confusing it. If I do interest income, it's just going slow. It will pull up. I could just go to the note in the book. Did it go up searching? It's going to pull up a note as we had done yesterday. It's working. It's just not searching. Let me try this. Interest income. I don't know why it's searching so long. I don't know if I've ever experienced that, to be honest. It's going to actually pull up. It's slightly different than what the annual report had. You can actually probably just see it right in the Excel. The note's slightly different. The note has, here we go. In some instances, it has no equity and earnings of unconsolidated affiliates in one quarter. They just didn't mention it at all. They did mention everything in foreign currency gains and losses. So just to note, when you pull up the note, it wasn't in every quarter, but in some quarters they just had the interest income and foreign currency line. They didn't have all 3 lines. It's just a slight difference. Did it come up? No, it didn't come up. But I have it in the book. I have it identified in the book. Okay. Secondly, another thing that you might get caught up in. First of all, note that they have 2 columns here, 12 weeks ended and 36 weeks ended. We just were doing the quarter, so we want 12 weeks ended. Okay. And when digging up depreciation to pull out of here, if you go to the cash flow, they only have a 36-week ended cash flow. So a lot of people get thrown off by this. So if you were to identify depreciation as 616 and try to pull out, your numbers would be skewed. So if you're doing Q1, Q2, Q3, when you identify the 616 36-week number, you can use this, but you have to subtract out the Q1 and Q2 depreciation to get the depreciation from just that quarter. So that's why, I don't know if I cut and pasted hard codes, but in here, if you look at the depreciation for Q3, it's the reported depreciation, 582, right up here, minus Q2 minus Q1. So again, it might be a little confusing when I'm talking it out, but this is exactly why you should have tried it on your own, and then now this is more of a reflection. Otherwise, you're pulling down for provision for taxes. Again, make sure you're backing into the tax rate differently because we're pulling out expenses from above, non-controlling interests, and then you want to pull in the EPS. Everything else is pretty much as normal. Okay. Now that we have quarterlies and annual reports, we can proceed to adjusting, because we want, this is the data that's given, we want this data given to be on Walmart's timeline. Remember, we started talking about LTM and calendarization. And we mentioned Walmart's timeline, that their year-end timeline is January 31st, and their LTM timeline is July 31st. So when I say year-end, these three columns are going to be the columns that we're going to pull in for our underlying metrics for comps. We're going to have one past year, one current, and one forward. The past year, I call it year-end adjusted, because it's not the reported 2012. It's the financial data as of Walmart's year-end time frame, January 31st, 2012. Sorry, 2013. So the question I'm going to ask you is, how do we get there with this information? And when I say LTM 2012, it's not LTM on Costco's timeline, it's LTM on Walmart's timeline, which is as of July 31st, 2012. Sorry, 2013. Sorry, 2012. The projected year is 2013. Now, it's hard to think back to when that was happening. So let's break that down. I want to break that down into a little bit detail. So the task I want to do now is, now that we have all the historical information laid in, I want to talk about how do we adjust Costco to get to those time frames. Okay? So let me pull up my OneNote where we started talking about this. Okay? Okay, so this is an example of calendarization. Let's look at this a different way. First of all, we want to get to information. So I'm going to take Walmart's timeline, right? The 2012 year end, okay, is as of January 31st, 2012, okay? This is Walmart's timeline. Their LTM data is as of July 31st, 2012, okay? And we need Costco's data to be in that time frame, okay? So let's first take Costco's information and think about, how do we adjust Costco's data to get to July 31st, 2012? Let's get a Costco adjusted year-end data. So let's see, what does Costco have? Okay, so Costco, try to get a different box, it doesn't matter. Costco has the following reports. What was given for Costco? Okay, so first of all, Costco had a 2012, Costco has a 2011 annual report, okay, which is as of, do this, which is the period from August 29th, 2011, okay, to September 2nd, 2012. That's Costco's year end. Okay. Costco also has a 2012 year end. Let me do this. They have a 2011 year end, they have a 2012 year end. Let me go this way. The 2011 year end is from August 30th, 2010, pretty similar, to August 28th, 2011. Okay? They have a 2011 year end, they have a 2012 year end. Okay? They also had reported 3 quarters. They had a Q1, Q2, Q3, 2011 and 2012. And they had Q1, Q2, Q3, 2012. These are all the recent reports that Costco had reported. Oops, that's not going to work. Okay. So there, we have Q1, Q2, Q3. Okay. The Q1, 2011, is from August 30th, 2010 to November 21st, 2010. You're going to have to look at this and let this sink in. The second quarter is from November 22nd, 2010 to February 13th, 2011. And the third quarter is from February 14th, 2011 to May 8th, 2011. Okay, so let me just pull this out so it's legible. There you go. Okay, and then we had 3 quarters in 2012, which is from August 29th, 2011 to November 20th, 2011. The Q2, which is November 21st, 2011 to February 12th, 2012. And then Q3, February 13th, 2012 to May 6th, 2012. Okay? So, a lot of information. The question is, let me make this font a little smaller. This is the timeline of all the reports that were produced. Perfect. Kind of perfect. Okay? We want to get to January 31st, 2012. This is the information we hard-coded in. How do we do that? Think about it. It's going to take a while. Pluses. So if you're starting 2012, you're overshooting, right? You want to get to January. So if you start with 2011, let me highlight this. Can I highlight this? If you start with 2011, you can color the font. You can't highlight. Okay. I'll highlight. If you start with 2011, then August, you just need to add quarters to get as close to January as possible. So what's the next quarter? So you want to go to Q1 2012, right? This is August 2nd, August 28th. Here's the very next day, August 29th. So if you add in this quarter, okay, this gets you to November. Okay, closer, right? If you add in the next quarter, this gets you to February 12th. So February 12th is slightly overshooting by 12 days. The best way to do it is count it. So how many days are in this quarter? Well, if you count from November 21st to February 12th, if you just count them, it actually comes out to be 84 days.
Is an Excel formula, right? Equal days or something?
There is. I just counted. Used my fingers. Well, hold on. Let's finish this one. Let's finish it and then we'll go. So when we have this, we have 84 days. Okay, here we count 84 days. And what do we want to do with these days now?
Take the 84 days minus the difference.
Okay, what's the difference?
12 days.
12 days we don't want. So we can add in Q2 and then subtract 12 days, or why don't we just add in the difference? So 84 minus 12, why don't we just add in 72 over 84 days? We want 72 out of these 84 days. 72, the first 72 days in this quarter is the days November 21st to January 31st. So if we use this, I wish I could draw like a pencil, like draw an arrow. Maybe you can. I don't know. But if I take this and take 72 out of 84 of those days, okay, then that would get us all the way up to January 31st. There's got to be a way to draw. I know there is. With the Surface Pen there is. But so 72 out of 84 of this quarter, okay, would get us there. No drawing tool here? No, well. Okay? And if we're taking 72 out of 84 of Q2, we have to subtract. Now, whatever we add here, we have to remove the prior quarters of. So we now have to remove Q1 and Q2 from the year before. Okay? But we have to remove Q1 and then 72 out of 84 of Q2. So if we're adding not 2 full quarters, but if we're adding 1.5 quarters, we've got to remove 1.5 quarters to make sure that it's 12 days, 12 months. Okay? Any other questions? Yes, you had a question.
I don't know, maybe there is some special formula for it, but let's say if you want to subtract the fourth phase, get the exact time. If you have quarterly data, let's say net income or whatever, and now you should divide everything to 120 days and subtract each amount for the...
Say it again, I'm not following. Say it again, I'm not following. So if you have, what's the situation?
If you just get rid of the quarters,
Mm-hmm.
and the other rest of the data is gone.
Yeah, so we're keeping 72 days.
And for the daily, let's say net income for 120 days for one quarter.
Net income for 120 days.
Yes, and we should divide 120 days and the subject for 12 days, not 12 subject.
Well, no quarters have 120 days, right? Quarters 3 months. Quarters 90 days. So what's the question on 90 days? If we count in 90 days?
No, I mean, my question is how we find each value for 1 day, each subject 1 day.
I don't understand. What do you mean, how do you find the value? How did I find that it was 84 days?
No. If you want to subtract the 12 days.
How did I know it was 12?
No, we know it's 12, but the value which is equivalent to 12 days in the financial reports.
How do we adjust the revenue?
Yes.
We're going to do that next. Okay. That's what we're going to do. Now, to apply this to Costco, yeah. Obviously we're going to get that done. That's what we're going to do next. So let's talk about how to use this. So now that we have the formula, remember the formula is Costco 2011 plus Q1 plus 72 over 84 times Q2. Does that make sense? And then we have to subtract out the prior Q1 and 72/84 of Q2. Does that make sense? So now we can apply this to the model. So in the model, we're calculating our year-end adjusted because we're calculating things up to January 31st, 2012. Right? So we're going to take, just as we analyzed, the 2011 plus this year's Q1 plus this year's Q2 times 72 over 84, right? Minus last year's Q1 minus last year's Q2 times 72 over 84. And that gets you an adjusted year-end as of January 31st, 2012. So that's what we have to do. We have to do that for every single line item all the way down. Yes. Okay? And what we do is we just copy this formula down only for the hard codes. Because the totals, we want to make sure that they're totaling as normal. The totals and the metrics, you don't want to make the adjustment for the totals. So just the hard code items. So I'm just going to copy this down to the other revenue, to the COGS, to the OPEX, to the D&A. These are where the adjustments are made, only to the hard-coded items, okay? To the income line items, okay? To the interest expense, interest income line items. And then all the totals and the metrics you can just copy to the right. So I know that I'm doing this quickly. I'm going to do this quickly just for the recording, and then I'm going to hold for a few minutes to make sure you guys get caught up. Do that up to EBT, and then there's a couple of exceptions we're going to have to make. So I'm just going to copy this to the right. Very simple. Copy this to the right. The totals. Okay, and you should have 2519 for net income. So I'm just going to kind of pause right here and make sure you got. All right, so next, taxes. I know taxes is a formula based on 36%, but the adjustment we want to make is to the actual tax dollar amount, not the tax rate. We don't want to adjust the tax rate using our LTI metrics and then back into it. You want to adjust the actual tax number and then recalculate our tax rate as normal. So let me know if you have questions on that. So I'm just going to copy down the adjustment formula for that. This is the implied adjusted taxes. And I'm just going to back calculate into what the tax percentage is. I don't think it'll make much of a difference, but just to note that. Okay. And then we're going to copy down to non-controlling interest. This is what you guys should get. Also, although trivial at this point, all of our non-recurring events. Okay. Looks like we're matching up. Are you guys getting that? 1509.4. Let me know if there are questions on that. All right, this is where it gets a little tricky. And what about the shares? What do we do with the shares? Share count. What do you guys think we do with the share count? Why? Same as what? But the same as what? Well, this is actually after, right?
Okay, and then in case it will be same what we got.
What is like here?
Yes.
What are we at? That's Q3. Where are we at in the share count? What do you guys think? Anyone else think what we do with the shares? Anyone have any thoughts on the shares?
So we got the same part what was before is subtracted.
Okay.
And see the differences between two quarter and all of that. And adjust it for this.
Yeah, that could be. Anybody else? Well, that's 9 months later, right? That's what Erdal mentioned in the beginning. We're 9 months before that. Right? We don't want the latest. That was Erdal's point. What do we want?
Can we just go take a look at the 10Q at that point and see what the...
Could. Which is when? I'm trying to think here. It's Q2 2012?
Yeah. Some 12 days ahead, maybe.
It's probably as close as you can get. I mean, some people, this is a weighted average, so some people just pull that formula down. But the problem is shares is a balancing also, so a safe bet could be just to take the Q2 because that was the time that it happened. That was the quarter, the share count that quarter. I think that's what kind of you were starting to say late after your first statement, is as close as the share count that we're trying to get to. Q2 2012. You don't necessarily make the adjustment. It's not like revenue. It's not like what's reported in a particular period. It's an accumulated balance. So at Q2 2012, we had a share count of 435 and 439, and that's probably closer to where they would be. Now, it doesn't make so much of a difference. Look at this. It's like 1. But it's just the idea of it to make sure that you know where things are coming from. Does that make sense?
So you take the latest, like where you project up to the latest.
Yeah, like the closest. Yeah, because shares are a little bit different, right? Shares is an ongoing accumulating balance, like a balance sheet item. Okay? This is what we get. Everybody have that? Anybody have questions on that? Mm-hmm. The general? This one?
Yeah.
Oh, I just yeah, okay. Yeah, that's it. Doesn't make too much difference. Very small.
I thought you were just that as well.
No. Okay? Okay. Now, that's our Costco data as of January 31st, 2012. What about LTM? What do we have to get to?
The latest 2012 that came out?
LTM?
The last 12 months of the latest quarter of 2012 that came out.
For who?
For costs. No, for Walmart.
Walmart, which is what date? We did yesterday. July 31st, right? Okay? So, think about this. Let me take this highlight out of here. How do I unlight? This is the data we have. How do we adjust this data to get to July 31st, 2012?
Well, we have the whole year's information. We should calendarize it based on that, out of the whole year.
You could do that. Now, so just step back. That's a good point. You could always just say, well, let me take an annual report and just kind of haircut that instead of doing all these quarterly adjustments. But people want the detail because the quarterlies capture the swings. So let's say we want to use the quarters. So if we start with 2012 and we got to subtract out 2 months that are in Q4, Q4 is not a reported quarter, how do we get Q4? We have annual report. We got to subtract. Yeah, we got to subtract. We have to create our own Q4 by subtracting Q4 to the annual from year 1, year 2, year 3. And then we can make our adjustments, and we still have to figure out what adjustments to make. So the first thing we need to do is let's create Q4s. So here, this column here, there's the columns I gave you. We have to create Q4 by taking 2011 and subtract Q1, Q2, Q3. Once we have Q4s, then we can adjust our Q4s as discussed and continue that discussion. So it's actually easier than it looks, than it sounds, if it's laid out like this, which I'd given you. If we take 2011 and subtract Q1, Q2, Q3, we can just copy that for every hard-coded line item. So we copy that down for revenue. We copy that down for COGS, just Control-V all the way down. Copy for SG&A, copy for D&A, copy for, those are the other incomes, copy for interest, okay, copy for taxes. What is that? Non-controlling interests and non-occurring events. Just copy down, Control-V all the way down. And then the totals, just copy the totals to the right. So for the totaling line items, just do Control R all the way through. And if you're worried about formatting, this will fix the formatting that was erased by copying down. Like here. Oh, it didn't do that. Didn't fix it. It was supposed to. I thought it was supposed to. Okay. One side note, like we did with the adjusted, is the taxes you need to calculate. Don't copy that to the right, because there's a little change in logic here where we hard-coded our tax rate. We don't want to do that. So we have to readjust our taxes. So let me see, take a second, get you guys caught up here. Okay, good. So continuing down, just note the taxes. So before we had backed into taxes, but it's really the tax line item is the one that we want to make adjustments to. So when doing these things, I want to make an adjustment. I'm going to make an adjustment to the tax line and then back into the implied tax rate. Copy to the right. Copy the rest of the total to the right. And what do we do for shares?
So for tax rate, just hard-code 35%.
No, we calculated it. Don't hard-code. Don't hard-code anything in these columns. What do we do for shares?
The end of 2011.
The end of 2011. It's the annual. It's the annual number. The annual number, this is a balance, is the number of shares, which is from the right. So the shares here is H56, H57. Make sure you're pulling it from the right. Tax rate, just calculation as normal. Cortez, you just got to download the Excel model instead of editing it live. I don't know, what do you right-click? You right-click on it and then say Save As. Save a copy. Yep, no worries. All good. Yeah. And we have to do the same for the next quarter. Now, the pattern and formula, the next quarter is exactly the same thing. So you can just take this whole column and you can do a big Control C, the whole column, Control C, you go over here and Control V, and it's going to give us what we want. It's the same, the right column minus the prior three columns. It's the same thing. Okay? It's going to give you this, it's going to be the same pattern and formula. Yeah, this might take some practice. So I mentioned on the weekend, I would recommend hard coding the quarterlies on your own, mashing the numbers, doing this on your own. It's going to take some practice. Okay? Everybody have this? Okay? Sure? All good? Okay. So basically what we've done was we have Q1, Q2, Q3. We've added a Q4. So I'm going to add a Q4. Whoops. And the Q4 2011 is going to be basically everything from May 9th, 2011 up until August 28th, 2011. Okay? This is what we added. We added this Q4. Okay? And I wish I can split this. I don't know if it's going to let me cut this. Let me see if I can cut this. I can put this underneath because we're running out of room here. If I can cut this down here. Ah, nice. Okay. And then the Q4 2012 is going to be everything from May 7th, 2012 to September 2nd, 2012. That's the last quarter. Okay? Do this. Perfect. So let me do this now. Let me see if I can take this. Let me just move some things around so we can lay it out. Okay, so move like this. This is what we have, okay? So we have annual reports. You have 4 quarters of 2011, 4 quarters of 2012. We have to get to July 31st, 2012. How do we do it? Now what? What do you think?
You take
Mm-hmm.
what difference we want to go. Let's say we want to subtract.
Let's do the subtraction way, yeah. I can't get this in line. Go ahead.
If the annual
Okay.
of 2012 minus
Go ahead. I'm never going to figure this out. Okay, you take the
pull it from the top right over there.
top right?
Yeah, like right from there.
That's going to pull the whole thing, though. I didn't want to do that.
More space.
No, I want to try to align the boxes, but when I do this, I don't know. I can't explain what it's trying to do here. Yeah. Okay. Go ahead. There might be a way just to control, just pull one angle. I don't know. But go ahead. So you're taking the 2012.
Taking the 2012 year end.
Right.
And then minus.
Yep.
July 31.
Yep.
And 31st is, we got to count the dates. I don't know the top of my head, but
Yep.
the difference.
Yep.
Divided by the total months.
Yep.
That's the
Divided by the days.
Now that we have less than a year, we have to add something else, which is 2011's same subtraction.
Yeah. Yeah. Now, a couple of weird things going on is Costco reports in weeks, not in quarters. That's what's one weird thing, which is fine. We're just counting the days. It's not going to hurt us too much. It just makes it a little bit more annoying. You just got to be careful about counting the days. The second thing is, for some reason, 2011 year had like 52 weeks. 2012 had like 56 weeks. However the year was laid out. I don't know how that happened. So we got to be careful, be just extra careful about counting the days. So for example, if you look, Q4, when we subtract, we have May 7th to 9/2. It's almost 4 months. It's a huge quarter. It's just so weird. It's just the way Costco had reported their annual report. So it's abnormal. Just short answer is just make sure you count the days. So if I count the days in that quarter, I actually get 119 days. I got 119. Maybe I miscounted. I don't know. 119. And yeah, 5 times 9, 119. And if you want to eliminate July 31st to 9/2, that's 33 out of the 119 days. So you want to subtract 33 out of 119 days in that quarter. You just got to count. Just count the days. If you subtract those days in that quarter from that quarter, you're basically wiping out
of the year.
That tail end. Okay? And then you're going to be a little bit short in the year now. So you need to add back the prior. And in this quarter, if you count, the days are a little bit different. It should be equal. It should be you're adding 90 or subtracting 90. But the way Costco's accounting was in this year, it's going to be a little different. So again, you just got to count the days. So the year before, they had 112 days. And the days we want to add back are the days because we want to start August 1st, 2011. We're going to go from August 1st to July 31st. So you only want to keep August 1st to August 28th. So you only want to keep 28 out of 112 days. So what we're going to do is we're going to subtract out 33 out of 119 days from that Q4 and add back 28 out of 112. So you might think, well, it's a little weird because it's 4 or 5 days off, but it's just the way their accounting was. That'll get us from August 1st to July 31st.
Question, how do we get 28 again?
You just want August 1st to August 28th. You want those days. You want August 1st to August 28th. You want those first 28 days. Just count it, 1, 2, 3, 4. Yeah. That's it. Right? So we want to, of this tail end that ends in 9/2, we want to cut off July 31st to 9/2. So we cut it off from the Q4, that little chunk, the last 33 days we cut off. And then we add back the 28 days to get us from 8/1 to 8/29. Okay? So, in the Excel formula, for LTM, we take the latest 2012, this year's 2012, we subtract out the Q4 we just created, the last Q4, times 33 over 119. So we're cutting off the last month chunk. We don't want that. And we're adding back the prior Q4 times 28 over 112. That should give us an implied value of Costco in line with Walmart's LTM. And we copy that all the way down. There it is. Copy that down. Copy that down. Again, not the totals. Don't have to deal with the totals. All the hard-coded line items all the way down. Okay. Now this is funny here. What am I doing? Oh, this growth rate, it does not make sense anymore. Copy to the right, all the metrics, the totals, as usual, or as we had done before. Oops. Oops. Okay, you should have 1659.6. Everyone getting that? Anyone getting that? And for the shares, what do we do for the shares?
closest, which is Q3, I believe.
It's Q3? It's Q4, right?
Q4.
Yeah.
Q4.
Which we pulled from your end. It's all the same. So where was that? That's the, yeah. The Q4, L or M is the same thing because L came from M. That was the latest quarter that has the July in it. Okay. It's all very similar numbers, but that's not the point. The point is that you know how to think about it. Okay? Got questions on that? Anybody?
Yeah,
Yes.
with the year-end adjusted.
Yes.
That's going to the latest date that we're analyzing it from, or is it, do we set the date for the year adjusted?
That's the date we set from Walmart.
Okay.
Yep. Every comp needs to be adjusted to the company that you're comping against days. Okay?
Oh, can you also upload the notes file with the calendarization information in the drive?
Yeah. Do you guys know how to? Can you save this? I can export it maybe. Yeah. I'll play around with how to export it. I'm sure there's a way. Maybe I can print it to a PDF. What does paper mean? Paper. No. Well, that's cool. Okay. Making projections. Okay, we're going to do this just like we did an income statement. You know, it's at your discretion how detailed you want to get with the projections. The way I've seen it, believe it or not, how detailed we work with the historicals, I've just seen more of a shortcut. When I say detail, I mean, do you build a depreciation schedule? Do you do a debt schedule? And actually, we're not building a full operating model here. That's not the point of the comp. We want to keep it to one page. What I do is I take a look at Wall Street Research Composite, in order to hone in on revenue projections and respective cost projections. As a first cut, I use the same logic that we talked about when looking at Walmart, which is I pull down the, let's say Yahoo Finance, the analyst composite research report. I look at what they say for revenue. It's in the book, right? Remember we did that with Walmart? And we match revenue growth to be in line with what the street says. And then I take for costs, I take the percentage of revenue from the year before. I just do that all the way down. And I look at what EPS, how EPS falls in line with the street. If our revenue falls in line with the street and we did cost percentage of revenue and our EPS is in line with the street, and that's the way they did it. If our revenue is in line with the street and we did the cost, same percentage of revenue as the year before, but our EPS is too high or too low, then you know the street must have made some sort of major cost assumption that we have to go in and dig into further. And you can break down the income statement from down up to see where the adjustments could be by looking at your income statement in line with getting on an earnings call with reading research. Because we know now, from doing this in complete detail in an operating model, each section here where projections are allowed, we can kind of read between the lines to figure out what's going on with the company. In other words, if, you know, going all the way from the bottom up, if interest expense if there's a major adjustment to interest expense and interest income, that must have meant there was a major debt issuance or a major debt paydown. Listen for that. If and that's usually not the case. If the company has divested a major portion of their assets or done a major acquisition, that would result in a jump or a drop in depreciation. Usually not the case, but you got to listen for that on the earnings call. Next up, OpEx. Right? If you hear on the earnings call something about cost cutting or maybe getting increased pressure from maybe minimum wage increasing, then you know there must be an adjustment that needs to be made to SG&A. This is what you got to listen for now. If they talk about pressure from commodity pricing or manufacturing costs or things like that, then you know that there must be an adjustment to COGS. So you can now, if your revenue is matching the street, but the EPS isn't, these are the things you want to listen for on an earnings call or earnings transcripts to think, okay, maybe the street is collectively making an adjustment to SG&A or OPEX, et cetera, based on that. And you want to back that up with some assumption. This is a great, quick, first cut way to make assumptions. Of course, you want to do your research, but just as a first cut. Now, when you look at these earnings composite reports, you want to look at the high and low range too. The range should be relatively tight. If the range is vast, that means the analysts are divided in some way. So you want to listen for that. So sometimes people say, well, some analysts, think maybe there's some legal issue going on where some analysts believe that the legal proceeding is going to be resolved, and some analysts believe that it's not going to be. If it's going to be resolved, revenue goes up. If not, revenue goes down. If the high and low is spread, then you might think, okay, the analysts are divided, and you have to kind of come in. And in an operating model, this is where we make high and low scenarios. But in a comps case, you got to kind of make a decision for why the analysts are divided and what do you believe. But generally, and I'm going through this quickly because we talked about this before, and we'll talk about it again when we actually build an operating model, is a great first cut way to look at assumptions. So when we look at Costco, and I can pull it up live, but if I pull it up live, the numbers are going to be different than this book, which is a little bit dated. The analysts on the street gave, I'm just pulling the page, an expected revenue projection of 6.6%. They just said they have the revenues, and they said on average 6.6%. So let's use that. Let's use 6.6%. So I'm going to go 6.6. It's going to be blue. Okay, and then I'm going to take the percentage of revenue. I'm going to just do total revenue. Year before times 1 plus 6.6%. And then I'm going to take the same percentage of revenue as the year before, go all the way down, and let's look at if the EPS is in line with the street, given the fact that we've used the street growth. Okay? Let's do that. Let's build our income statement projections. So I'm going to take 88% growth. I forgot in the book if I hard-coded 8.88 or if I did equal to the year before, just so we can match the numbers. It's a minimal difference. I hard-coded it. So I'll take 88%, and I'll take 88% times the revenue, and we'll go down. So why don't you take a few minutes, make the projections, and let's see where we're at. Okay? 9%. Even depreciation. I decided not to build the depreciation schedule. You know, as you discussed, no matter how you build it, oops, it should be in line with growth, with revenue. Okay, you guys getting this? 2073.3? Just pause for a second, make sure you're getting that. So I should be pulling from, I don't know why I assumed the right column is, that's not the latest information. I should be pulling from 2012. This is the information that the analysts are projecting off of, so I want to simulate that. I'm sorry. It's a good point. So let me just change this to be off of 2012, and then the rest going down should be, so this 88 should be off of 2012, which it is. I mean, it's the same. 9 is 9, okay. This is 1. Okay, we're okay here. That shouldn't change anything else, okay? For things like this, and this is a little bit crude, for the other income, I just pulled the year before. I've seen this done a lot. Again, it's up to, you can get into as much detail as you want. We're going to get an adjusted net income. It's going to make minimal difference. Even for interest expense and interest income, I didn't do a debt schedule. So I'm just going to copy this down. And then taxes, I'm going to use the 2012 tax rate. I'm going to hard code 36%. I'm going to back into taxes. And just give it a shot. You should get 1683 for adjusted net income. Or sorry, 1314. So why don't you take a second to try to get down there. Okay. Continuing down, I'm just going to pull this information from the prior year, assuming it's holding pretty steady, and copy the information to the right. And then again with the share count, I'm just going to take the share count from that year that we're projecting off of. I'm not going to assume it's going to change that much. And this is what you should have for projected EPS. Huh, it's dropped. Oh, I'm sorry. Oh, we're doing projections, so we're not done yet. Okay, do you guys have 1290.5? Yes? Any questions here? Okay. We're overdue for a break, so let's take a break. What I want to do is all right, so now we're at the number of shares. How do we project the number of shares? Where do we get the most, where do we get the latest number of shares? Not necessarily quarterly or annual. In this case, it was an annual after. So the latest filing. So let's do that. So Costco's latest filing was the 2012 10K, and on the first page, right? So on the first page, we should have, that was weird. Let's try that again. It seemed to have crashed. On the first page, we should have number of shares as of October 5th, 2012, 432,424,379. So that is the latest number of shares. Okay, now if you notice under the comp, and you should have this under every comp, a box where we'll build out the diluted shares and we'll calculate the equity value and enterprise value. So I'm going to hard code in the basic shares of 432,424,379. So 432,424,379. If you notice, this is similar to the way we laid it out in Walmart. 432,424,379. Okay? At the time, you can look up the share price online, but since this is dated at the time, the share price is $96.94. And we need to go through the process of diluting the shares. Now, we're lucky in that the latest report is an annual report because the annual report has more information than the quarterly. If the latest report was a quarterly report, to get diluted shares, you got to find option tables in the prior annual report, and then you got to look up SEC.gov for any potential stock issuance that happened after that annual report. In this case, since the annual report was released like 5 or 6 days ago, there was nothing else recent. You just have to go through every document. It takes hours. Every 8K, you just got to click and just make sure. And what's helpful now is in the SEC.gov, they actually give a little description to the right of the report. They used to not, where if it says registration of securities or issuance of options, it would say it. So it makes it a little bit easier. But from the last report that you've identified that would have option tables in there till today, you have to go and dig up all those reports and see if anything results in any new options raised above and beyond what you'd found. Okay? So to get the options, you got to do a search for. There's a few things we want to search for. I'll search for options. I'll search for warrants, employee stock. These are the things we want to search for, and they're usually spread across multiple tables. If you're lucky enough and you have one combined table that lists everything, it makes it easier for you. But you have to do a lot of digging. And I know, yeah, I spent a lot of time going through this, and this is the only table that came up. I know I made it look quick, but it took a while. All stock options, fully vested. It was simpler here. At the end of 2012, they had 3161 outstanding at a weighted average exercise price of $40.90. Okay? Now, the options that we laid out were in actual numbers. This is in thousands. So I'm just going to do 3161000. I don't know how to break it down into any more detail. 3161000. Okay? That's the number of options in the money. And the strike price is $40.90. Okay? And if you had found several tables, you'd have this several times. You have number of outstanding stock options A, B, C, the respective options and their share price. And you'd kind of do like a sum product. Okay? Now, the question is, are these options in the money? Yeah, absolutely. 90 is way above 40. So we have to use the Treasury method to exercise the options and get an implied value of diluted shares. So how do we do that? You guys remember? We're going to practice this a lot in M&A, because in M&A you always got to dilute the shares, right? We'll talk about why. You almost always. So first of all, we got to calculate the proceeds. If every shareholder were to exercise, they'd exercise at 3161 times 40. Right? They have the right to buy a $90 share or $100 share at $40. So they're going to pay $40, and they're not making any money until they sell it back in the market at the current price. They want to make money on the spread. So if they all exercise, $129 million will be out in the market, and they got to assume the market's going to buy it back at the current price. Otherwise, they're not making the spread, right? So the repurchase value is the $129 million out there funded is going to be purchased back at $96. So there's going to be, of 3 million stock option contracts exercised, 1.3 million bought back. And so the number of diluted shares ending up outstanding in the market is the 3 million minus that 1 million, or 1.827 million. Which one? Divided by the proceeds divided by the 96. Mm-hmm.
And then the additional shares outstanding is whatever difference between 3161, right? The number of outstanding options minus the one that is on.
Mm-hmm.
The formula.
Correct.
But what if you change like the share price to like 10 or something like that? Would the number still work? Like say the share price.
Well, the calculations will give you negative values.
So therefore, is that right? Or
It's wrong.
so then how would you make that more robust?
Well, if this was 10, you wouldn't be diluting your shares. You wouldn't be doing this. Yeah. Yeah, they won't exercise. Yeah, I mean, if you want to do it so that this is like a max zero. So, yeah.
Put in condition, right? If the average option strike price is less than share price.
Or just max the formula comes zero. Or is it min? Yeah, either way, you know what I'm saying, if you want to do it that way. But it doesn't make sense. It's never going to go below 40. I mean, in the time of. Mm-hmm. And so the diluted shares would be the basic, of course, plus that 1.8 million. Okay. And we can pull these into our projections divided by 1,000,000. These are the values we're going to use, right? So in our projections here, this is the more accurate. The basic shares is going to be the 432,424,379 divided by 1,000,000. And the diluted shares is the 434,251,720 divided by a million. Okay? Got it?
How did you get 432? That's the
That's
basic? This guy basically divided by a million?
Yep.
Okay.
Did I do that right? 432, 434, yep. Interesting that it dropped. Seems unusual. Maybe they did a buyback. Okay. We can now, you okay? Yeah? Question on this?
I think I got some weird error. I just put a 0. It's into the right.
Maybe a mislink or something?
Right, where does the 434 link to? Sorry, can you just divide that by 3?
Mm-hmm. Yep, divided by a million.
Sorry.
This one?
Yeah.
Mm-hmm.
What the number of outstanding basic shares?
432, 424, 379. Mm-hmm. Four three four 25172. Interesting. I got something slightly different. 3161 4090 129 9694. Interesting. Did I miss? In the book, it's off by 1 decimal. 9694 432 424 379 3161. Yeah. Oh, it says it's going to be up right. Right. In Excel, the one in the book I did with a calculator. Here is Excel, so there's going to be a little bit of a difference. It's fine. Okay, so just in preparation for the comps where you need market value and enterprise value, I like to calculate it here in each individual comps page. Now you do this and then you copy this tab for every comp that you have. So market value, everything is going to be based on the most current diluted shares. So it's going to be simply the diluted shares outstanding divided by a million, because I want things in millions, times the current stock price. Okay, so 42096.4. Okay? Good? And then to get from market value to enterprise value, you want to include all the components of net debt plus maybe some other things, short-term debt, long-term debt, less cash, non-controlling interests, preferred securities, capital lease obligations, any non-operating liabilities, everything that could build from enterprise value, market value to enterprise value. So you got to pull up the balance sheet, and I believe this balance sheet was early on. I could be wrong. I believe it was earlier in the state. Yeah, cash flow. And on the latest balance sheet, they have 3528 in cash. So let me throw that in there. And I'm going to put 3528 as a negative minus 3528. Okay? Because it's going to be all the debts less the cash, right? You guys okay? And I'm going to look at any other short-term debts. The current portion of long-term debt is 1. Anything else? And long-term debt is 381. So I'm going to add that together. I'm going to do long-term debt includes current portions is, 1381 plus 1. So 1382. I don't see any short-term debt. There's no like just straight short-term debt. There's no capital lease obligations. There's no convertibles. Is there preferreds? There is preferred stock, but its value is 0. Is there non-controlling interests? Non-controlling interest is 157. And then we add everything up. It's 4107.4. These are the underlying values we use for our comp tables. Now we have everything we need to create our multiples. So make sure you have those numbers. Okay? Okay, so if you look back at the table, we're going to lay out all the multiples. You need the current stock price, which you just pulled in, the market cap, the enterprise value. Notice what I've done. This is just my personal preference, or actually I got this from Morgan Stanley, but the table has underneath an underlying table that lists the underlying metrics that we're going to use to calculate the multiples. So in other words, you pull in the 3 years of sales, the 3 years of EBIT, 3 years of EBITDA, and then up above, all the multiples are driven from the table below. The reason why I prefer that is because I used to see a lot of mistakes with people clicking to the tab for the numerator, back, clicking to the tab for the denominator, enter, and then you go to the right. And you're going back and forth, and I always see a lot of mistakes that way. If you do it this way and you're just pulling in sales, copy to the right, EBIT, copy to the right, DNA, copy to the right, then the multiples, you're just copying down because all the formulas are the same. You're just taking every row and just copying up or down because it's pulling exactly the same way from underneath. I've noticed it's an extra step is the negative, but the positive is it avoids the possibility of linking the wrong column. So up to you if you choose to do it that way. So I'm going to pull in for Costco sales, the 3 columns. So the sales are going to come in from the Costco comp. I'm going to start with sales, of course, revenue. This year-end adjusted, I'm going to copy to the right. Okay. EBIT, year-end adjusted EBIT, which is here. Copy to the right for the 3 years. DNA, Costco DNA. Copy to the right 3 years. EBITDA, I guess I could have just added, or I'm going to pull EBITDA. Copy to the right 3 years. And EPS, I always take the adjusted diluted EPS. Adjusted meaning the clean one, and then the diluted. Copy to the right. Okay?
So what do you do also with the adjusted diluted? Why not just the basic?
Okay.
Is it for the dilution? Is it?
Number one, why do we do diluted for everything in the comps? We mentioned it several times. We always do diluted everything. Why?
Because it affects the equity value.
In which way?
In the case of the dilution.
Why would that matter though?
Because you're trying to see how much the company is worth its market value.
Yeah. And then why adjusted?
Because there's extraordinary.
We want everyday operations. We want clean, but it's important. You want for our comps, we want multiples pulling out anything extraordinary that might maybe artificially inflate or reduce the earnings. And we want a diluted picture. We want a picture of what if everyone is going to exercise on their stocks today, whether it's an acquisition scenario or a standalone scenario. That's the true value is the convention. Good to clarify. Okay. Take a few seconds. Do you guys have this? then we can run the multiples. So to run the multiples, we got to pull in for the current stock price that we have in the Costco comp. Market value, which we have in the Costco comp, and the enterprise value that we have in the Costco comp. And then we have to divide. Now you can look underneath. You can actually just take this bottom row and copy it up. That's the point of setting it up this way. Or just so you know, and you probably do, the price to earnings, I'm going to take the current stock price. I'm going to anchor the column, so I can copy that to the right, divided by the earnings per share that we just pulled in. Copy to the right two places. Enterprise value to revenue, take the enterprise value, divided by the sales. Sorry. Copy to the right. Enterprise value to EBIT, take the enterprise value. Divided by EBIT. Enterprise value to EBITDA. Okay. So that's what you should get. I'm going to pause it. I'm going to stop for a second and make sure you guys are all caught up. Okay, so let's just kind of see what this means. What does this mean? How do we read this? What does this mean for our company? Why do we do all this? How do we think about this? Now, how do you conclude this? So this is Walmart. So this is what Walmart's trading. We did 4 different types of multiples. The PE. We did enterprise value to revenue, enterprise value to EBIT, enterprise value to EBITDA. And we want to compare Walmart's multiples with its competitors if you believe these are their competitors. If you're looking at PE, one thing to notice is, and a couple questions should be in your mind. What metric do we use? And which time period? And a lot of this is subjective, right? So if we look at PE, for example, time period, whether it's 12, LTM, or 13, is about 14 or 15 times what they're trading at. The peers, look at Costco. Costco is double that. We got guys slightly below that. Dollar Tree is slightly below that. You know, these multiples are pretty spread out, right? You have 9, 20, 30, and 15, right? If you go to the other end of the spectrum, in contrast, enterprise value to EBITDA, Walmart's trading about 8 to 9 times. Their competitors are trading about 8, 9. Costco's on the higher end, 11 times. Right? The range is tighter. This is anywhere from 8 to 11. It's about a 3-point spread. This is 9 to 30. Why could that be? Is that normal? PEs seem to be a much wider spread than enterprise value to EBITDA.
What is what the market pays for?
Both based on that. Right, both based on the market from perspective of the numerator.
One considers debt, the other one doesn't.
What difference does that make?
If it doesn't consider that the value, like we're looking at the core value of the business, so it doesn't change. Whereas I think price to earnings considers the capital structure as well.
How does it have an impact though on these metrics? Or why is that an impact?
Well, there's a leverage effect.
What's that? What effect is that?
Well, there's a leverage effect with the PE ratio.
How specifically?
It bumps up. If it has a dollar, is it your core business? Then
Like P ratio is net income, sometimes there will be some extraordinary stuff, so your net income probably will be very, very low sometimes, so it makes like P ratio range become bigger.
Yeah. Yeah, and that's super important. Let's look at this real quick. Let's say we got two companies. We have Company A and we have Company B, okay? There's two distribution companies. Let's say we're UPS. We want to acquire one of these businesses, okay? And let's say Company A, and I'm gonna need to have, oops, Company B, okay, fine. Company A, Company, oh, this is, let me do it real quick. B, and these are the metrics, okay? And let me just make this font big. And let's just say we got a font, fine, 20, this is good. And we have this, Company A, Company B, okay? So, and let's say in terms of revenue, and we're at UPS, we're doing M&A or buy-side M&A, we want to look at acquiring one of these companies, okay? So let's say Company A, Company B, let's say the revenue for Company A is $10,000, okay? Let's say Company B, the COGS for Company A is $2,000, okay? We're analyzing Company A, okay? Let's say X for Company A is $1,000, okay? So Company A has an EBITDA of $7,000, okay? Now we look at Company B. Okay, let's say Company B, and these distribution companies are based in New York, right? Company A is based in Manhattan and Company B is based in Brooklyn, whatever. So Company B's revenue, $10,000. They also have COGS of $2,000. They have revenue of $1,000. They have EBITDA of $7,000, okay? Kind of the same, they're operating kind of in the same way, right? They each have, let's say they each make 10,000 deliveries in a period and charge $1 delivery, whatever, same volumes, okay? Now let's say Company A and Company B do operate a bit different. Let's say Company A, they have D&A of a truck of $1,000, okay? Let's say on top of that though, because Company A is based in Manhattan, they have to build a warehouse for storage, and they build it out in Queens. So actually the depreciation is a little bit bigger, it's $3,000. Okay, Company B just has the truck. Let's say Company B, is a guy driving a truck out of his garage. He stores everything in his house. No high depreciation. Okay, let's keep it that way. Because of that warehouse that Company A has built, they have interest of $4,000. That's a lot of debt, let's just say, just to illustrate the point. Company B has none. Okay? Company A net income, 0. Company B net income is $6,000. So if we look at the PEs of these companies, if you look at the net income, it looks like Company A is performing much worse than Company B, where really that impact is capital structure related, right? If you compare just the operations of the business, they look like they're both relatively successful. So if I'm UPS, I got to look at what I care about. If I'm UPS and I'm saying, listen, I just care about the customer base, I care about the shipments, I care about the deliveries, whoever I buy, I'm going to wipe out the debt and I'm going to wipe out the warehouse anyway. I might have been falsely misled thinking that Company B is performing better when it's really not. This is where EBITDA becomes a different way of looking at things. On the other hand, if I'm an investor and I'm investing in the stock, the capital structure is of concern to me. So for this reason, if you look at PE multiples, a lot of times the multiples do seem all over the place because some companies are structured differently from the capital perspective. Some companies have a lot of debt, some companies don't. Some companies have a lot of depreciation, some companies don't. That's reflected in the PE multiple. And this is why, if you're valuing just the assets of the business, a lot of times you're more concerned about EBITDA because it's a reflection of the customer base. You're more concerned about just the enterprise value to EBITDA multiples, and this is why a lot of times enterprise value to EBITDA multiples trade a little bit more in line. And that's kind of what you see here. These companies are probably built differently in terms of their capital structure. When you look at an EBITDA basis, it's a little bit more in line, like 8 to 11. There's a couple things you want to look for then. So what's more important to me? Is it PE? Is it enterprise value EBITDA? And most of the time we always look at EBITDA. You probably hear a lot about valuing off of EBITDA, enterprise value EBITDA, because of what I just explained. There are some instances though where PE is a little bit more important. Let's say tech companies where these aren't big companies with huge assets. A lot of times their EBITDA is negative. You just kind of look at PE, capital structure comes more importantly into play. I don't know, there's some other examples of that. We'll look at that more, tomorrow. So the interpretation of the comps is what I want to focus on. And I want to focus on the P page, finishing up the analysis, maybe doing another DCF example tomorrow. Okay.
Maybe you can explain this tomorrow, but like, when would you use EV over EBIT versus EBIT? When you want to, like, when is the situation when you want to include depreciation in the calculations?
Hotels, real estate, where depreciation comes into play, as an example.
Is it sector specific? Like, generally, there's like an agreed upon multiples that the industry uses?
It could be sector specific. It could be also depending on what you're analyzing as well.
Right.
So just as I explained before, I gave a sector example, but I also gave you situational examples where within that sector you might want to look at one versus the other.
Okay.
So it's hand in hand.
Just like in equity research, for example, like sometimes you get multiples, but then the analysts like disagree with the multiples.
Yeah.
Can you explain how that works? Like probably tomorrow or something.
Well, I can explain that, but what do you mean?
Like for example, like say, oh well, we don't believe that Costco is trading at 11.7
Yeah.
times, but we believe that it's going to be at like 13.
Yeah, you know what? Equity. If you're looking at equity research, like every year, equity research groups put out like a big industry report that's like 100 pages. It's like an amalgamation of every report that they've done and an industry overview. And the argument always is how companies trade. Do they trade? You may hear they trade better on earnings, or they trade better on EBITDA. They have the underlying argument is what I had just discussed. Do people value the debt that's on the business? Do people value the depreciation, or are they valuing just the operations? And in a lot of operationally focused companies, it's a no-brainer. It's EBITDA. Who cares about the capital structure? In examples like real estate, where debt and the buildings, the value of the buildings come into play, it's a debate back and forth from bank to bank, and it's a perspective. It's a fight. So it all depends on how much weight you put on the capital structure and how much weight you put on the underlying assets that are creating those operations. So that's a debate what concerns that debate is not only the sector but the transaction that you're analyzing and how you're valuing it.
Is there a relationship between the multiples and let's say Walmart's multiples and the beta of the stock? Would there be a correlation?
There is a correlation between the beta and the numerator driving those multiples. But EBITDA or the underlying metrics, if it is, it's so tangential to it.
Can you explain that first point, like how it drives?
Well, because it's literally calculated based off of the stock prices. The numerator is based on the stock prices. I'm talking from a little perspective. That's exactly where it comes from. Do the multiples drive that? Maybe if there's multiples that drive some market perception, which drives the stock price, yes. So it's one step removed. The more direct impact is the stock price, daily stock price returns. Good line of questioning. We'll open up with that so we can talk more about that. We're going to conclude with this, and then I'll give you maybe some more examples and take it from there. Cool. Good. Thank you.